We'll go over how to pay yourself as an LLC in today's video. Most new business owners in 2022 want to figure out how to make the most money feasible while decreasing their tax liabilities and minimizing any tax obligations they may have. Many people, on the other hand, establish enterprises without knowing how to pay themselves. Guys, if you've recently formed an LLC or are considering doing so, you should be aware that how you pay yourself is quite crucial. Look no further than this video if you want to learn how to pay yourself. Let's get started. Now, before we go into the best way to pay yourself as an LLC, let's go over what an LLC is again. A limited liability company is referred to as an LLC. An LLC owner, or the owners of the firm, cannot be sued or held personally accountable for the company's debts or liabilities. In the event that something goes wrong with the firm, LLCs are designed to safeguard business owners from losing all of their personal assets. If the firm is sued or is required to repay a big outstanding debt, for example, the liability protection provided by the LLC helps to make things safe enough for many people to feel comfortable beginning a business. Many people would be hesitant to start a business if limited liability protection was not available. They would be terrified of being held personally liable for all of the company's debts and liabilities. There are single-member LLCs and multi-member LLCs. Single-member LLCs are owned by a single individual, whereas multi-member LLCs are owned by numerous persons. Whether or not you have partners will determine which option is best for you. If you don't have any partners, you probably want to start with a single-member LLC, which is probably the best option for you. If you have partners, a multi-member LLC is probably the preferable choice to pay yourself as an LLC. Though an owner's draw is the greatest option for single members to pay themselves as an LLC. So let's talk about it. You may have heard of the term owner's draws, which are also known as owner's distributions. An owner's draw is a sum of money taken from the company and given to the owner. The first step in setting up your owner's draw from your limited liability company is to open a business bank account. You'll need your employment identification number or EIN number. When you form your LLC, the government will provide you with your EIN, which you will need to open a business bank account. You might think of this number as your company's social security number. When you try to open a business bank account, you'll be asked to supply this number. You'll be able to establish the company's bank account attached with that number after you give them your EIN. Once it's set up, you'll be able to start storing money earned by the business in the business bank account until you're ready to pay yourself with your owner's draw. Simply transfer funds from your corporate bank account to your personal checking account. Owner's draws are used by LLC owners to pay themselves distributions from their business in lieu of wage. As long as your business remains an LLC and does not change to an S Corp or C Corp, you can utilize the owner's draw to pay yourself dividends from your business. You don't have to pay yourself at even intervals while taking your owner's draw. You can pay yourself whatever you want, as frequent as you want, and whenever you want. However, you should be cautious of overpaying yourself because you need to preserve enough cash in the business bank account to pay your taxes and cover expenditures. So, if your company made $200,000 in a year, but you had $80,000 in expenses, you should not pay yourself more than $120,000 over the course of the year, because you would struggle to pay for those expenses. It would be preferable to pay yourself $100,000 and leave a little cushion because you never know what unexpected expenses will arise in addition to your regular spending, LLC payments, and taxes. The beauty of LLCs is that they combine the greatest features of corporations and sole proprietorships into one package. Despite the fact that LLCs, like corporations, have limited liability, this implies that for tax purposes, the owner and the business are one and the same. So just like sole proprietorship, your LLC revenues are considered personal income, which means you aren't taxed twice. Even while you won't be taxed twice as a single-member LLC owner, you will be liable to 15.3% self-employment tax. Social Security receives 12.4%, while Medicare receives 2.9%. Many people believe that this tax is excessive. It's taxing and insane, and I talk about how to prevent it on this channel every day. You can convert your LLC to an S Corp to avoid self-employment tax. You will, however, be compelled to pay yourself a respectable income if you do so. You can still take distributions on top of your reasonable pay, but your salary should at least be 30% of your annual business income. Many people who start out as single-member LLCs eventually switch over to S corporations to avoid paying self-employment tax. That is just what ends up happening as you grow if you switch to an S corp. Then you only pay the payroll, and you will still qualify for the 20% Qualified Business Income Deduction, the QBI, which allows small business owners this additional 20% on all net business income. The tax rules for LLCs will remain the same in 2022. However, there are a couple of general tax adjustments to be aware of. The standard deduction, for example, will increase. The standard deduction for married couples will increase from $25,100 to $25,900, while the standard deduction for individuals will increase from $12,550 to $12,950. It will increase from $18,800 to $19,400 for head of household. The standard deductions is the amount you are entitled to deduct from your taxable income on your tax returns every year if you qualify with no questions asked. You can take the standard deduction instead of itemizing your deductions. Another major change for 2022 is that the taxable income maximum for the QBI deduction, which we previously discussed, will be $170,050 for single filers and $340,100 for joint filers. This means that if you wish to take advantage of this deduction, your income must fall within these limits. This year's taxable income limits are higher than last year's. Last year's single filers paid $164,900, while joint filers paid $329,800. So just to recap, here's a quick synopsis. If your firm is sued or has a big debt called in, a limited liability corporation limits your exposure and protects you from losing all your assets. Many entrepreneurs benefit from this liability protection since it gives them the confidence and security they need to grow and launch a successful business. If you form your own limited liability company, you can pay yourself by taking an owner's draw or a distribution, which is when you take out money of your business bank account to send it to yourself. As you go, you'll learn to convert to an S corporation, which allows you to take payroll. You utilize your EIN number as a taxpayer to open your bank account, which will allow you to be paid as an LLC owner. If you keep your company as an LLC, you have to pay yourself employment tax, but you'll only have to pay it once because the profits of your LLC are considered personal income for tax purposes. Switch to an S corporation if you wish to avoid paying the hefty self-employment tax. However, I must caution you to recognize when it is appropriate to convert to an S corporation. So let's wrap things up. If you have an LLC, it is crucial that you pay yourself correctly, as failure to do so may raise an IRS red flag and result in negative consequences. If you have any concerns about how to pay yourself, how to form an LLC, or where to go to convert your LLC to an S corporation, leave your questions in the comment section below and I'll respond. Don't forget to smash that like button and notification button, and please subscribe to this channel. See you in the next one.